Good morning, good afternoon, or good evening, depending on your perspective on the world. And welcome to Trading Coaches Playbook. As my dog starts barking in the background there. Of course, hang on a second. Let me change. The background's fine, I guess, but I was going to change it to something else here. There we go. Anyway, I want to welcome everybody here. My name is Brandon Wendell, and hopefully you can see my screen and hear my voice. And of course, hear my dog in the background there. Pascal, stop. They seem to do that as soon as I turn on the microphone. They seem to kind of know. I don't know if all dogs do that or if it's just mine, but anyway, got a picture of the one right here on my shirt. It was actually his birthday yesterday. He's 3 years old. It's Pascal. And it kind of looks like the shirt. It was just a random thing. But anyway, so good morning, everyone, or again, depending where you are, good afternoon. I'm going to get started here. And just, I like to have fun. So just kind of casual and, Pascal, it's okay. I got this. So I just want to remind everybody that we are not broker dealers or investment advisors here at Freedom Management Partners. I'm going to take a look at different markets, but it's only from an educational standpoint. I'm not telling you to buy, sell, or hold anything in particular. We're giving you any personalized recommendations. And trading always has the risk of loss. There's nothing we can do to reduce or minimize. Sorry, it's nothing we can do to eliminate the risk. We can only minimize or control the risk, manage it basically. And we are not subject to trading restrictions, so I can have a position in a security or initiate one at any time. That being said, moving on a little bit, we're pretty busy here at Wealth Builders HQ. As you can see, we got a lot of free online workshops that you are more than welcome to join us for. Power Hour every Monday. Rob does a great job there looking at the different markets and teaching some concepts. We also have every Friday this Trading Coaches Playbook where professional traders share some of their knowledge and intimate knowledge of the markets and how they apply those markets. We have the market mornings every day during the week, key to be free, just a lot of stuff going on there. So if something interests you, then make sure you sign up for it. Lots of free information there, as well as some premium information as well. So moving along, if you want to stay in touch with us, you can always email us at support as well. If you got any questions on anything, it's support@wealthbuildershq.com. Oh, good. Pascal's sunning himself now. He's relaxing. So you can keep in touch with us there or on the different web features, as you can see on the screen. I also have my own personal ones, which I'll show you as well. BrandonWendell.com is my own personal website that I've got where you can follow me and see the different courses that I offer. I have Brandon Wendell CMT as a YouTube channel as well. And I didn't put it up there, but if you do a search every week, I'm doing a video called The Wendell Effect. So you can search for it on YouTube. It's just, again, the Wendell Effect. And it's really good. I give a lot of good information about the markets. I do some chart schooling in there. So free data, free information if you're interested in doing and watching that. Again, just do a YouTube search for the Wendell Effect. I have an interview coming out this week with a trader who has been through the rigmarole, if you will, of learning how to trade. And she figured out her best way to achieve success. And she's going to share her secrets and her kind of story with you this week. It's really neat. She's a successful crude oil trader. So make sure you look for that on YouTube on Monday. It'll be out. I'm also on LinkedIn, Facebook, all the other stuff as well. So getting to the topic I want to talk about today, I want to go there. Oh, what did I do? There we go. There we go. I just erased the chat for a moment. So basically what I want to talk about today is what's called sector rotation. And sector rotation can be used for a couple different things. Number one, it can be used to figure out where we are in the overall market. So I'm going to go perhaps to a weekly chart here of the S&P index. Oops. Hey, Lucy. The dog just came and sat by me. So the overall market, goes through bull markets and bear markets. And part of what we need to do as traders is figure out where are we in that overall movement of the markets. And more importantly, basically, where is the next stage going to be? Are we in a bullish stage, bearish stage? What's going on? So obviously, I really rely heavily on the charts themselves. And looking at the charts, we can see that we had a nice bull market since that pullback back in 2020. That was the COVID pullback, and we reverted back to a bullish trend. But recently, you can see that we started finding weakness. So pretty much everything you need to know is literally on the charts. But there are a lot of support tools that we can use to help guide us to understand what's the highest probability future movement of these markets. And right here, we see that prices were moving up. And unfortunately, as we were moving up, we were losing momentum. The indicator I'm using on the bottom is called the RSI, or Relative Strength Index. Now, I'm not going to go into heavy detail on the RSI today because it's actually something I teach in much more detail in my program that I have. One of the programs I run for wealth builders is called the E-mini Think Tank. And in the E-mini Think Tank, it's divided up into several different pieces. I might as well show it to you. Go to wealthbuildershq.com. Part of it is education and part of it is trading or application. So when it comes to the education, you can actually get more information, as I mentioned, on brandonwendell.com. So if you go there, you'll see as you scroll down through the website, the Wealth with Spreads program. Let's see, where else does it have? E-mini Think Tank right there. That's my mom and Larry Holmes, their neighbors. If you ever been a fan of boxing, he was the heavyweight champion many, many years ago. So anyway, getting back to this on the E-mini Think Tank right here, you can click on that link and it'll take you to the page that gives you more information about it. Now on that page, and for some reason this happens sometimes, get back. My mom looks young. She won't let me like this, me saying this, but she just turned 75 last week. So she looks great for her age, I think. Yeah, absolutely. And she acts young. So anyway, right here, you can see register for E-mini Think Tank. So yeah, I like to think I got some good genes passed along, definitely from her. Anyway, so looking at the login here, let me get in that real quick and just show you the program. That's why I look young too. Yeah, I got the good genes from my mom. So anyway, again, I don't want to spend too much on that, but when I go into the members section here, you'll see that the first part of E-mini Think Tank has a bunch of education in it, which is on demand. Additionally, we meet 3 days a week, Mondays, Wednesdays, and Thursdays. So right here, I go to E-mini Think Tank. And my calendar is obviously very full, but here on the E-mini Think Tank, there are basically bonus videos that have education. There's quite a few of them. In addition to the education, there's documents that support that education as well. So you can learn things like how to use that relative strength index, or how to trade options on futures, how to pick tops and bottoms and identify trends properly, and individual strategies as well. So I have them all just, again, as a video, but also documentation supporting all the videos. Now, in the 3 sessions we do per week, Mondays, Wednesdays, and Thursdays, they're all recorded, so you can watch them if you can't make it live. What I do is I put out trade information. And what we do is we practice by identifying what's going on in those trades. I pick the trade ideas and we pick them apart just to see, should this be something we want to get into, or maybe just watch, and then we track the trades to see how they would have worked. So April's not up there yet, but I got March. It's asked me to download. I'll do it this way. Go ahead and jump into it. Oh, that's the cash flow. Yeah, I'll just open. Anyway, I wanted to get the more recent one. And if I open, just go to E-mini Think Tank. It's only take a moment. And there we are. So we go to April 2022. And I track every single trade. Now, this one's not completely updated yet because I didn't close out some of the trades, but you can see that there are a lot of trades that we identify we're just not able to take. So there are 32 no entries, but overall we had 11 winners, 5 losers so far. So we had a pretty good win rate, a little under 70%. And the main thing is I want to keep my losses very, very small. I don't have to have a huge win rate of a 90 or 100%. Because my losses are extremely small compared to the potential gains in the trades. And that's why we get that gain overall. So Amy has just posted the link for you. If you're interested in learning more or jumping into this program, if you do the quarterly subscription versus the monthly is, what is it right now? I think it's $3.99 a month. But if you do the quarterly at $9.95 a month, what'll happen is you get a 2-week free trial. So you get to try it out and see if you like it before you commit, which is pretty cool. So again, if you use that link that Amy just put up in the chat, why did that not go? Hang on, select all, no, not that. Copy, paste, Oh, let me copy and paste there anyway. Let's see. Minis, think tank, EP. There, that should get me there. And again, if you go ahead and click on that link, it wasn't a clickable link though. That's why you just had to copy it. That's all. And when you go to it, again, it'll give you the information. Whoa, what happened here? I must have copied something down wrong. But anyway, you can also get to it, like I said, using brandonwendell.com. It'll give you the opportunity to subscribe if you're interested. But and I'll get to our content now in just a moment here. But again, I just want to make sure this is working here. E-mini think tank. Yeah, that's the same link that was just posted right there. Oh, actually, I'm sorry. There is a discount going on right now. I forgot. So there you go. There's the actual link that just put through in the chat. And if you go to register, you'll notice there's actually a discount. So it's not the $9.99 and $3.99. It's $3.49 for the monthly and $7.49 for the quarterly. So you get a nice little break there, a little bit of a discount. If you go into the quarterly, it'll automatically give you a 2-week free trial. So there's no charge on your card for the first 2 weeks. If you decide it's not right for you, you just cancel, but you had full access to everything beforehand. So anyway, that's that. Let me continue on with our discussion. The chart itself, as you can see, gives us that warning sign before things started turning around. And then here we got confirmation of a trend reversal. So again, in that E-mini think tank, there's information on how to identify trend reversals like this based on the data that you're seeing here. We had a high that was not above 60 and we're in the bear trend now. So when we just had that rally coming up, this is a weekly chart, but if the rally back in March, I knew that even though we broke to a new high, this was not likely to continue to move upwards. And we were going to go ahead and end up making fresh lows. Even the Fed announcement on Wednesday, which caused the big rally in the market, was not enough to change the trend. It was what we call a dead cat bounce, where you get that small rally and eventually just everything drops. So even going down to the daily chart, you can see very, very weak, even though we tried to rally up. There's just no momentum. So anyway, one of the tools that we can use to identify where the markets are likely to go is what's called sector rotation. So I'm going to go to a couple of free websites. Stockcharts.com is one that I like to use. And the other is FinBiz. And I'm sure there's others out there, but these are two that I can use with a lot of good information on it. So on stockcharts.com, I go to charts and tools. And as you see on the left-hand side, there's something called performance charts or PERF charts. If I go to the predefined groups, they have S&P sector ETFs. So when I go to the ETF sectors, or S&P sector ETFs, it divides the markets up into these different sectors. So you can see if I zoom in a little bit, oops, there we go. We got discretionary, consumer services, technology, industrials, materials, energy, consumer staples, healthcare, utilities, financials, and real estate. Sometimes real estate is thrown in with the financials. So what do we have here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 sectors. So it depends on where you go. Sometimes you get as few as 9 sectors, sometimes as many as 11. I've never really seen it more than 11 sectors. By the way the market works out, it's almost like a big funnel. Okay, what you have at the top of the funnel, let me just do this, is the broad market. And to represent the broad market, we use indexes or indices. Right, and with those indexes, you've got the S&P 500, NASDAQ 100, Dow, really Dow Jones Industrial Average, and then the Russell 2000. So those are, for the most part, the big indexes in the broad market. So we can do analysis to see where the broad market is going. You can either do a top-down approach or a bottom-up approach when you're trying to analyze the markets and figure out where individual securities might go. Or you can even just keep it simple and trade the broad markets, but the smaller pieces inside that funnel can help direct and tell you where the broad market's likely to go. And that's kind of what we're putting together here. So under the broad market, we have sectors. As I said, there's anywhere from 9 to 11, and they're just broad groups of securities. So we have, as you saw, consumer discretionary, consumer staples, utilities, energies, all sorts of things. And when you take a look, you'll notice they're actually using ETFs or exchange traded funds as a way to track them. They're a little bit easier than trying to track the indexes themselves. There is an index for discretionary. There's an index for energy, technology, materials, all that. But it's sometimes easier just to track the ETFs, which typically move one for one with the broad index as well. So it just gives you a little bit easier of an opportunity to be able to figure out what's going on there. Underneath these sectors, again, I can go in and find what are called industries. And there are roughly 197 of them. And basically they are subdivisions of sectors and basically more specific description of a group of companies. Oops, there should be sectors. There we go. So they're more specific description of a group of companies. Underneath the industries, you actually have industry leaders. Yeah, I cannot type today. So you got industry leaders, which are the big stocks or companies with the largest influence. Okay, so we can take a look to see how those industry leaders are doing, and that may give you an idea of how with the largest influence. That's fine. Anyway, I'm getting corrected here by Grammarly. So you can see that we can do, again, that top-down approach to figure out, okay, where's the broad market going? Which sectors are leading us? And again, it works both ways because the sectors can tell us where the broad market's going. Then we can divide it down to individual industries and then the leaders in that industry, and then follow the stocks that might be following the leader to know exactly where everything's likely to go. So if we want to see another view of this, remember, we just saw here on stockcharts.com sector analysis with the ETFs, the overall sectors. By the way, this is how they're performing against the S&P 500. That doesn't mean that for the last 200 days, if you had bought energy stocks, you'd be up 76%. Okay, don't misread this. This is showing you how the industries or sectors worked in comparison to the broad market. So if I click here on S&P 500, that's how the individual sectors performed. So sometimes it can be quite different. You know, if I go for the past week, for instance, right, you take a look at the overall S&P, and there's a lot of positivity on some of these, but when you take out the S&P itself, you see it changes, and only one was positive. That's the energy market. So if you want to know what sectors are actually performing well, you don't want to compare it against the broad market. You want to see how they are just in general. So you want to take that off if you're using this tool. Okay. Now, sorry. The other thing I want to mention, okay, sorry, I was getting messages here on my phone. So busy. Anyway, so what happens is if I want to take another look at this, FinViz has some really cool tools on it. One that I use is right here. It's the map of the market. So you can either click here on maps or just click on the map when it pops up on the home screen. So this is finviz.com. And what you'll notice is the sectors are the capitalized names at the top in the black. So if I zoom in again, you can see I've got communication services, consumer cyclical. Those are sectors. Healthcare, that's a sector. Financial, that's a sector. Now, looking inside of the sectors, you'll notice there's groups that get highlighted in yellow. Those are the industries. So we got credit services, insurance, diversified. That's an industry that is a part of the financial sector. We got financial data, okay, capital markets, again, pieces of the sector. So we can take a look over here. Energy, well, we've got 1, 2, 3, 4, 5 industries represented inside of energy. Now, there may be more, again, depending on where you go for your source of information, or there may be less. So I can see right here, this is the full S&P 500. It's not including every stock. If I go to full, it gets a little more crowded here, but you can see all the individual pieces. So let me go into consumer cyclical for a second here and zoom in a little bit. You can see I'm looking now at internet retail, and it's showing me the size of these boxes of the stocks inside of the industry. Those are created by market capitalization. Okay, market cap, if you're not familiar, is simply the price of the stock times the number of shares outstanding. So let me go back here to my paint and mention that. Okay, market cap, whoops. Or market capitalization is basically the price of shares times the number of shares. And the reason why that's important is because the majority of indexes that you see, remember the broad indexes tell us where the broad market is going. The majority of the indexes are market cap weighted. What that means is the bigger the market cap, the more influence that particular stock has on that index. So going back to our map, when we see Amazon, see how big that is for consumer cyclical internet retail? That's a major player, and that could have a lot of influence on the overall markets. However, if you go to one of these smaller squares, there's W, that's Wayfair. You can see it's much smaller. It will have a lower impact on the overall industry and maybe even the overall market. So that's a way of discerning, what's going to drive the markets and what's going to drive individual securities by looking at a glance as to what is our market leaders, market cap. The only index, does anybody know, actually, I'll just ask as a question. Does anybody know the only major index that is price weighted, not market cap weighted? There's one index out there in the world that is price weighted compared to all the others that are market cap. Anybody know? See who's awake out there. Got a lot of people in the room, so see if anybody knows. It's not the S&P. No, we'll see. Anybody else? Not the NASDAQ. Closer. You only got so many choices, right? Crude oil, no. ICL, no. The only index that is price weighted, nope, got them all except the right one. Somebody just said Russell. It's the Dow. The Dow is the only one that's price weighted. The bigger the price, the more weighting and impact it has on that index. And the only one that is price weighted still is the Dow. And that doesn't really make sense because, a company that has a high price doesn't necessarily have a huge impact on people's portfolios. Market cap does, because market cap tells you not just, the price of the stock, because it could be a cheap stock, but there's a lot of shares out there. So that market cap means if it's a very large market cap or mega cap, it means that many people actually own that security, and it should have impacts on more people's portfolios. So I agree that we should be market cap, not price weighted, because market cap affects more people. Makes sense, right? So anyway, let me go back over to the sector ETF and performance charts. And the nice thing about this website is it's got a lot of free data, as I mentioned before. Right here is the map. I could see just the Dow Jones Industrial Average. Yeah, that's the only one, not all the Dow indexes. And there are others, there's Dow Jones Transports and a few others, but just the Dow Jones Industrial Average is price weighted. It's the only one. So got a lot of trivia for you there, And I believe that's true for the world. I'm not positive, but I know it is for the US at least. Only price weighted stock indexes. There it is. The Dow Jones Industrial Average is price weighted. And I don't know if they have any others. Doesn't really show. So if you go to definition, I'm not sure if it'll say it or not, but yeah, it doesn't really say. Anyway, but that is. So getting back to the sector ETFs, again, I want to go on this page, stockcharts.com, under charts and tools. When you go to the performance charts, the predefined sector ETFs is what you wanted. I could probably just do this for you too. Copy and paste. There you go. So if I scroll down a little bit, now you see what's called the sector rotation model. Oops, hit the wrong button there. There we go. I wanted to increase this a little. So here's the sector rotation model. Now it talks about, I think, it doesn't show you here. Interesting. There's a couple books about this. I'm not saying you have to go out and buy the books. Honestly, I'm going to give you pretty much the overview of the whole thing in this video. But basically, what you see is in orange, that is the stock market. And in blue, that is the economy. So we're talking about cycles. And the stock market goes through bull market cycles, and then it turns around and goes into recession and bear market cycles. So the bull and bear market cycle typically leads the economy by several months to sometimes a year. It could be quite a bit of a lag. It just depends. But honestly, it normally leads. So what's happening is investors are speculating as to the future of the economy. So that's why you see the stock market will tend to rally first and tend to dive before the economy gets announced. You know, for a recession, for instance, really the definition of a recession is two straight quarters of negative GDP growth. Well, that can take a while. You know, by the time you actually get those 2 quarters, you may have been in a bear market for quite some time. So looking at the stock market, that's a better indicator as where the economy is going to go in the future than just waiting for the economy to change. So again, if we take a look back in the previous market moves, here's the overall index, and I'll go to a monthly chart and going back to our last big recession, you can see that the stock market peaked here in 2007, right? And officially was in a bearish trend in July of 2008. And the reason why I say it was officially in a bearish trend is because in order to be in a bearish trend, you must do this. You have to make a lower high, and following the lower high, you must make a lower low. So you see lower high, lower low officially right there. Let me get that out of the way. In July of 2008, that's where you officially made the lower high and lower low. Now, there were warning signs before that happened, by the way. I was talking about divergence before, and there's one. And this also gave you confirmation at that high because we couldn't get into bullish territory after the divergence. So even before we made the fresh low, we already knew it was going down. As a matter of fact, if you do a search, I'm not sure if it's still out there, but March 4th, 2008, which is right here. Nope, right there, that candle. I was on CNBC for my very first time, and I said the United States is going to go into recession this year. And this is pretty much the chart I was looking at right here. You know, you're probably thinking, how the heck did you know? Well, my crystal ball was working back then. No, I'm just kidding. Just overall, we saw the divergence, and I figured that we were getting ready to go. And sure enough, we were definitely confirmed right here. So I don't know if it's still up. Let me see. That's a Google it. And nope, it's got some other videos of me. So unfortunately, I don't know. March 2008, man, that's one. I had long hair for a while. Anyway, yeah, I'd have to look at them all for the videos. I don't know if it actually happens, but yeah, CNBC. And anyway, I'd have to find that video. So getting back to this again, also, we were taking a look at sector rotation. Now, unfortunately, this only goes back so far. You know, right now I can only go back to October 2008 and December 2007 to go over kind of the sector rotation. So I'm not gonna be able to show you the exact picture. I don't know if I have one. I'll have to look back and find it. But anyway, what I use this for now for sector rotation is I look to see who is leading us, and that can give us an idea of where we are in the rotation model. So if you see technology and discretionary sectors are outperforming everything else, and by the way, I'm not just talking about a week or two. You got to look at a longer time frame, maybe 6 months, 3 months at the minimum. Typically you don't want to go smaller than that because things can change on a day-to-day basis, even month to month. We're trying to get the overview of what's happening in the economy and looking at the bigger picture. So maybe 3 months on the short side. The nice thing is with this tool, again, this is free, but I can go on this one and right click right there, past 3 months, past 6 months, year to date. And you can even adjust it manually by taking that little indicator and shrinking it down by left clicking and dragging. So I'll do last 3 months. There we are. And again, you can go back to the beginning and the overall move in the markets. We'll go through this a little bit. So if you see the best performing sectors for 3 to 6 months are technology and discretionary, you're probably coming out of a recession and a market bottom. Well, you're not out of the recession yet. You're near the bottom of the recession. You're fully in it, but people are expecting the turn. And therefore, what they're doing is they're investing in stocks that have been beaten up really, really badly, and they're expected to climb out of that recession. If you start seeing communication services and industrials picking up, now you're the full bull market. Those are usually stocks are performing well as the economy is finally hitting a bottom and things are turning around. Okay, so you got to remember, investors and traders are forward looking. So the economy will take a while to turn around and catch up. Meanwhile, the traders are already banking on the fact that it's going to. So if you notice that materials and energy are the best performing sectors, you are close to or at a market peak. There's a lot of demand for materials when the the economy is, churning out a lot of products. We need those raw materials. Additionally, inflation becomes an issue and energy uses spike. So you're going to see that energy and materials are very, very bullish right near or at the market peak. Now we start doing what's called a move or rush to safety. And the first one that you see prices or money moving into is consumer staples. Okay. Consumer staples are companies that produce products that we use all the time, no matter what happens in the markets. Toilet paper, right? Hopefully when the recession hits, you don't stop using toilet paper, right? Please. Deodorant, toothpaste, products that we always seem to have around the house. You can even see some consumer staples can be things like alcohol. Believe it or not, when the market gets bad, unfortunately, sometimes the alcohol sales go up. It's just the way of life. And even, taking a look at between the discretionary and consumer staples, car manufacturers and luxury autos, especially, would be a discretionary item that people would use or buy when there's extra money that they have, discretionary money. But when times are getting tight and we're worried about a recession, you're going to try to keep that old car running as long as you possibly can. So the consumer staples, you might find auto parts stores as people are trying to get those last few miles out of their old beater, right? Also, healthcare goes up in value and becomes very busy for a couple of reasons. But one in particular is if there's layoffs coming for the economy, what will happen is many people will try to use their healthcare before they lose it if they're laid off. So you actually see a lot of usage of things before it goes to Cobra or they lose their Cobra. So the healthcare does well. Now, the interesting thing is as the markets are diving like this, what happens is the Federal Reserve also goes through a cycle. And their cycle is designed to try to help the economy and control inflation. So when the economy is failing and the demand is drying up, what you'll typically see is that the Fed acts by lowering interest rates. And they're trying to lower interest rates to make money more freer and therefore stimulate the economy. Well, utility companies are very interest rate sensitive. They operate on very high margin. They issue a lot of debt. Public utilities do this all the time. They issue out bonds. And what happens is if the utility companies see the economy is going down and the stock market's going down and the Fed lowers interest rates, they can call back their old bonds at higher rates and reissue new debt at a lower rate, and that helps their bottom line. So you see that in a bearish market, utilities perform very, very well as those companies are taking advantage of market forces to help their bottom line, basically get better debt. Then you've got financials, which also benefit from low interest rates. That's near the end of the move, though, because we need to start seeing the economy is going to be poised to recover. So financials with low interest rates and real estate along with it. So in a nutshell, that is the sector rotation. And by seeing which markets as a whole, and it's not just one, okay, we look at maybe 3 or 4 different markets and try to figure out, okay, where are we right now in this rotation? We can get a clue as to what's going to happen in the markets. So for fun, I'm not going to go to today's yet. I'm going to pull this back a little bit. And going back to pre-COVID, okay, so if we go into, say, a weekly time frame here on the stock market, and we go to 2020, I'm just curious to see, I actually haven't done this, but I want to see, is there any warning sign in February that we were going to do this drop? Now on the chart, there is. Right here on this chart, there's a huge warning. Now, we were doing pretty well in the economy back in 2020 until everything started slowing down with the shutdowns and everything that happened with COVID. Okay, I'm not going to get political here. I'm just talking about facts. So obviously the reaction was the stock market sold off quite a bit and then finally just completely recovered. But that initial move down was kind of preceded by a divergence here on the indicator where we didn't have the momentum needed to sustain those new highs. The question is, did the sector rotation have any help with this? So if we go back, oops, wrong page. There it is. And we take a look. Let's just do about 90 days. Yeah, close enough. So we go to 2020 and February. There we go. February 14th. That's pretty close. I think what was the high here? 18th, somewhere around there. Okay. So anyway, looking at this, if we take out the S&P 500, it doesn't really necessarily say that we're in a top of a bull market. We can see that technology was performing very well. And we actually had some good performance across the board, except for energy. That was the only one that was not performing well. So this one might have been a little bit of a surprise where sector rotation wasn't really part of it. Although if we pull back a little bit more to January, well, no, even there, we're still seeing that technology is doing really well. We do have a rise in healthcare here. And even with the market itself. Yeah, February 2020, there we are. Going back a little bit, January, February. No, it didn't really help with the rotation. I was just kind of curious. I was to see if it did, but it didn't. Now, if we go forward to where we are now, remember that was kind of a black swan event. That was a pandemic that hit and kind of changed everything. It didn't really have the economy changing everything. It was something else. But if we go forward now, or even back, let's go back first to 2008. Let's see how that worked out. So here we are in 2007 going to 2008. The peak of the market, by the way, was October 13th, 2007. Okay. So if we can go back in time, yeah, wrong one. Right here. There we are. And what do I got? December 2007 to May 2008. It's not quite where I need to be, unfortunately. But even here, just going, it's not going to show it to me, is it? I really need to go back further. And I had pictures of it. I just don't have them with me right at this moment. I apologize. But if you looked at the previous 90 days or even 180 days, do 90 first. You can see that right here, end of 2007, beginning of 2008, the best performing sectors, take out the S&P, real estate was still pretty hot. It hadn't quite cooled off yet, but notice where we were. We had the materials market and the energy market as really the only positive markets. This was pretty flat and discretionary. So if we use the sector rotation based on that, energy is edging out materials. That tells us that we're pretty much right here in the market, that we're near a market peak and therefore getting ready to turn to the downside. And I wish I could go back in history to show you all the way back in 2000, 2001. That also worked. That sector rotation model kept working. We can try to use it on smaller time frames for little dips along the way. So again, as we go forward, we had another dip here in 2011. Okay, so let me clean this chart up. Basically, what happened in 2011 on the chart itself, you had a little head and shoulders right here and broke down in July, August of 2011. So if we go, again to sector rotation, and we'll leave it on roughly 90 days. To 2011, and I say July. Yeah, July, August, April. Oh, look at this. It happened a little early. Notice we've got the markets are pretty bullish, but energy is really spiking. So the hottest market is energy. You still have some pretty good gains in industrials. So in mid to early 2011, this is suggesting that the markets might be near a little bit of a peak. As we keep going, look what happened. Just before the market dropped, you can see the change, right? Here, we were hot on the energy market, which basically tells us we are right here in the markets near a peak. And then true to form, look where the money went into. Defense, the safe sectors. This was in June, 1 month before that market started dropping in July. So sector rotation really did help there when it's an actual economic factor. Not that black swan event, like I mentioned with the COVID, but the actual economy changing direction before a drop. You'll see it as investors started rushing for the exit and started looking for safety in the staples, healthcare, and utilities. And sure enough, the market started dropping. So how long did it go down for? Well, right here, again, that was the start of the move down in July. We bottomed out in October of that year and started to rally yet again. Just kept going for a while. So if we move forward, that was so weird how everything flipped. But we had that bullishness right here, as you saw, the top of the market. And then as we start to become more bullish, we should start to see the beginning part of that market right there. That takes us off the bottoms. So this was June, July, August, September, October, going into November. And that was pretty much right here near the bottom of that market. We see the rotation telling us, hey, we're going to come out of that bottom and start to rally. So now let's take a look. Well, actually, let's do another one. Do another big drop that we had in the markets. Here we go. July of 2015, once again, we start to see weakness. We've been running to the upside very strongly. Now we're getting some weakness and pulling back. It wasn't very long-lived, but about 6 months or so. You can see we were dropping, making new lows. So same thing. We go to that rotation in 2015. Notice that once again, in early 2014, we've got that peak again. In the middle part, it gets worse. Kind of jumping around a little bit. Here we are now. What do I want? July of 2015 is the warning that I'm looking for. So April, again, bull market. Strong bull market where we've got participation with discretionary, consumer services, technology, and so on. Okay. Sorry, a question came in here. Is the slope or value of the RSI that's most important? No, it's the value. And also the highs and lows itself. That's really what's important. So moving forward here, we go into 2015, that mid 2015, and you can see that really this didn't quite warn us. This is still looking bullish. In June of 2015, we still have the strong bullishness holding out. That's next month, July. Let's see if anything changed. Yeah, look at that. End of June, notice we've got healthcare spiking and all these performing markets started dropping. That's telling us that we kind of skipped that energy peak and started moving right into the decline, didn't we? So there's a nice little warning sign. Obviously, the charts would tell you as well, but this is confirming that, hey, we might be getting ready to move down very quickly in these markets because the sector rotation is pointing that way. It's kind of neat, isn't it? And if we go to where we are currently, let's take a look at the last 6 months. Prior to actually January of this year, last 6 months going into the beginning of this year, December 30th, there we go. Overall, it's kind of mixed. I would expect to see, again, those stocks confirming the leadership when the markets are already turning down. So that didn't really help there. Let me try the last 90 days or 3 months roughly, again to January. So here we are in January. Once again, leadership is in the energy markets. And what has happened in the past few days or even weeks is, we're up 7.5 and 7.9. We're getting more movement into the safety of those discretionary consumer staples. But there's the peak right there. See, the actual peak of the stock market was what date? January 3rd. So going to that time frame and looking back, and it won't let me get it exactly there, but looking back over the last 6 months roughly, again, you're still seeing that emergence of the energy markets as a leader. So that can give you an idea as to where the markets are likely to turn. Now, there's something else I could do that's kind of interesting. By the way, if I want to know what to trade, or again, with that overall rotation right here, I can go to the S&P 500 or the world, doesn't matter which one, and look at the last 3 months performance here. And what do you see? The last 3 months, which sector has been the best performing? Oh, the most green is energy. And remember, that usually happens when the market is at a peak and ready to start dropping. And where should we also see some growth? We should see growth in consumer defensive. Notice the green here as well. And healthcare. Notice the green. And we haven't gotten really, well, there is some green. Look at that, in utilities as well. So the sectors that you would expect to be doing well in a bearish market, or as we're starting to drop, actually are. And that confirms that movement. This is just telling you what the overall environment is like. If we go back for the last 6 months, it gets even more glaringly obvious. The only green we really have, again, is in those defensive sectors. You got a little bit left in basic materials, which is near the top of the market. Energy was hot, obviously, but consumer defensive, healthcare, and utilities are the only other swaths of green that you really see. So this is warning you that, hey, the market is anticipating a recession. Big movements to the downside may not happen for 3 to 6 months, but that's where we're headed right now. And the traders are expecting that to happen, and they're trading accordingly. Now, I developed a little other way of kind of fine tuning this I want to go over with you. If we go back to that sector ETFs and we look at the extremes, consumer discretionary, again, that's used when the markets are doing very, very well. And you can compare that to consumer staples. Well, we'll use the ETFs for them. So if I go in here and I put in XLP, excuse me, that's consumer staples, okay? And I can compare that to XLY. Actually, I'm gonna do that one first. XLY, that is consumer discretionary. Okay, that's the ETF that follows the consumer discretionary sector. And when that sector goes up, then people are buying things that they wouldn't normally necessarily buy unless they have extra money. What we can do is compare the two. And this is nice. I can do this on my trading view. So we do XLY minus XLP. So I'm creating a custom chart, which is actually subtracting the consumer staples from the consumer discretionary. I'm getting rid of this index or indicator as well. We don't need that right now. Okay. Well, actually, I could use it too, but I'm not going to at this point. But this is kind of cool. What I'm doing is just simply comparing the two. By the way, if you want to use this trading view, I can get you $30 off if you're interested. If I go right here to referred friends and copy this link, I use the Pro Plus, I think it is. It's up to you. I don't care if you use it, great. If not, no big deal. But basically, I'll get $30. You get $30 off if you try to upgrade. So you can try the free version first and see if that's what you want, and or you could do this on different platforms. Sorry. So anyway, what I've done here is literally just showing you the chart of discretionary minus staples. Okay, so basically, if this line or chart is moving up, it's bullish for the market. And that's because the discretionary is doing better. If it's moving down, it's bearish. It's bearish for the broad market. It's a run to safety. So that's really what we're seeing right there, which is pretty cool. So what I'm going to look for are trend changes or trend breaks. Now, this is not for day trading, obviously. Okay, this is for longer term moves in the markets. So I'm going to do a comparison here. And let's see, where can I do that? Oh, just add. Wait, where is it now? I forgot. That's right here. Comparison. Oh, no, I can't do it this way. I've got to do it. Let's do it this way. Right here. I'm going to put in SPX on the bottom there. There we go. And we'll do the same time frame. We're on a daily chart. I'm going to go to weekly because, again, we're looking at a bigger picture here. So we got weekly charts of both the S&P 500 and that chart that I made of discretionary versus the staples. And what we should see is that when I line these up, when the trends break, it usually leads or signals what's happening in the broad market. Okay, so let's go back in time a little bit here. Let's go back to, I don't know, 2014, 2013 here. Let me clean up this chart. 2013, there we are. So looking at the top chart, you can see that we had a nice uptrend going for a while here. Long-term uptrend kind of snapped. And that's a warning sign that you might get a change in trend going on March 24th. There it is. It wasn't quite lined up. And you can see that even though this dropped, we pretty much went sideways for a while in the overall market. So we saw some weakness coming in the markets. And short term, that trend snapped again. You can see we were trying to move down in trend, but then we broke May 19th. And therefore, look what happened. That was the end of the sideways move in the markets, and we started to rally. So I can try to break this down. Let's zoom in more. Excuse me. Let's see, is that almost lined up? Almost. Much better. So once again, as we're watching these markets, this little indicator created on top, overall trend snapped again back in September of 2014. And what happened? After that trend broke, look at that. We had one more candle up and it warned you before that drop happened. Wouldn't that be nice to have a warning sign that you know before a drop happens in the markets? We got that warning. And how do you know when the trend's going to stop going down? Well, again, look for the trend break. Overall, trend stops going down. We tested by moving up, corrected and retested. And overall, in November of that year, we were done moving down. Now, it wasn't quite at the bottom of the markets here. What happened there? Oh, that's weird. But you can see that we continued our march upwards. So I'm just looking for overall price movement and changes in trend. And we had a pretty significant move up. But the overall trend broke at this point on the 23rd of March, 2015. And you can see that we went sideways here. Saw a lot of weakness, actually. And what happened? There's a breakdown again from our trend. And I'm not getting exact, but you can see the overall breakdown occurred right here, August. And wasn't that a nice warning sign? Look at this. Let's zoom in a little more. Notice the overall trend broke right here, August 10th. What happened? You had a 1 week warning sign before prices really sold off. Wouldn't that be nice to have? To know when the markets are really getting ready to drop. And even we can kind of fine tune this more. Notice higher low, higher high, possibly. If we get that higher high, we should be getting ready to move back up again. And there it is, confirming on the 26th of October, 2015. So if I go to October, it's a little bit late coming off the lows. But even if you notice higher lows, higher low, you would know that this is for real pushing to the upside. Started breaking down almost immediately after. Let me clean this up now. And again, when you get breakdowns in your trend, let's put that extend. So the breakdown was right here pretty much. What do we got there? December 7th. So December 7th, right there, that was a warning sign the markets are going to turn bearish. And that was a pretty good warning, wasn't it? Sure enough, we tried to hold up a little more and then collapsed. So this is a pretty good indicator that we can use to let us know where the markets are likely to turn around. And what I can do is apply just my normal technical analysis to this. So once more, before the markets change direction, often you get warning signs. And right here, or where's the turn? Back to the upside. Right here, there was a couple of warning signs that were great. One, on a move down, notice prices are trying to make new highs. But what's happening is we have what's called a negative divergence. And with the lower highs there, that's telling you we're going to go down. Now we made this low, but we didn't go below 40 on the RSI. Once again, if you want to learn more about how I use that RSI in detail right here under my bonus videos in the E-mini think tank, this will help you out on everything you do. So if I go right to that video, relative strength index, it teaches you in depth how I use the RSI. Additionally, under the fundamental documents, RSI rules. So you can figure out all that stuff and then you can apply it right here in these charts. So I'm making a low, but I'm failing to get below 40. That tells me we have underlying bullish pressure because the staples are still going to outperform. Sorry, the discretionary is going to outperform the staples and the market should rally from that area. And sure enough, that's exactly what we did. And if you're watching the stock market at that time, that is 2015 in August, it did the exact same thing. 2015 August, we were near that bottom of the market and rallied up very strongly, very sharply. So that's the nice thing about being able to read these charts properly and understand the difference between the two opposite sectors. You know, right here, we had another warning sign before everything dropped. Okay, I put it right on this candle as the actual warning for the drop. That's December 2015. But before that happened, look, we tried to move up just slightly. We have a high here of 32.24. We made a higher high, 32.27. Wasn't much, but we had no momentum. That's a negative divergence. And that usually leads to a pullback in price. And there it was, the pullback. So if you had seen this on November 30th, okay, forget about this one, just November 30th, that was a divergence that was confirmed and telling you the markets were getting ready to drop. Well, if you use that warning sign, November 30th, was that ample warning that the markets were going to drop? Yeah. And we dropped from 2,100 basically down to almost 1,800. So that was a really good save there to let you know what was going to happen with the markets. If we continue on to where we are currently, let me clean up this chart, beginning of this year. Again, same thing. We can use this on the weekly timeframes, bigger picture. And what you see at the beginning of this year, prices are trying to move up in November of 2021. But what's not happening is the momentum's not going with it. That's a negative divergence and a warning sign the markets are getting ready to come back down. And again, this was on that comparison chart. So we had a warning sign there. Not only do we have a warning sign, but in the RSI, you actually get signals that will tell you trend reversal. We had confirmation of trend reversal that happened here because he made another peak where the RSI was below 60. So not only do we have the negative divergence, but we had the confirmation after the negative divergence. That tells you there's a rush to safety and the stock market's going to come down. That confirmation was January 10th. Okay, we had the warning sign back here in November. That high wasn't confirmed until we broke the low of that candle, which was the 10th of January. And it was telling us that markets were going to go down. Well, what happened? $2020. What did I say it was? January? Oh, I forgot the exact date now. Oh, that's 2020 anyway. January 10th, 2022. 21. Where are you? There it is, right there. So that was your warning sign that the markets were going to get weak and pushed back down. And sure enough, that was pretty ample warning, wasn't it? Before things got really bad or worse. And, you know, we're rallying back here in March of this year. Yeah, it's pretty accurate, isn't it? So what happens when we're rallying in March? Okay, so we look back here and we see back in March, we've got a little bit of a rally on this indicator that I created. However, two things are happening or not happening. Number one, we can't get into bullish territory. So right here, as you closed and went below the previous, right there, you put in a peak basically, and we couldn't get above 60. So number one, we're not getting into bullish territory. This is continuing to move down. There's still bearishness. Number two, the trend. Connecting highs, now it's not exact, but it's pretty close. 1, 2, 3. We're still in a downtrend, aren't we? So that alone is telling us that we're going to keep going down. So the rally that we experienced in March was doomed. And you can see right there, April, we go to the stock market and there's the rally in March. And right here, early April, April 4th, wrong button. That was telling you this is not going to sustain itself. We're making that lower high and we're actually going to make new lows soon. And there it is. So we had plenty of warning before everything started turning down, if you knew what to look for. And the same thing, I can go down to a daily chart instead of the weekly and see if I can fine tune this a little more. I wouldn't go less than daily on this at all. But overall, on the daily chart, same thing. You can see when the highs and lows are not matching up and trends are changing. This is showing lots of bearish pressure. Now we have a little bit of a pop that might come next week. You see, we made lower lows here in price. We didn't make those same lows. Okay. So we might get a little push to the upside, but that's going to be short-lived. Remember, we're on the daily chart. So expect a small bounce in the stock market on Monday or Tuesday, as we've sold off quite a bit this week, but don't expect much out of it. We'll continue to push down. So like I said, that is one way that we can use the sector rotation and really kind of fine tune it by taking a look at the discretionary versus the staples to really time our changes in the trends. And if you're looking for what to trade, even if you're not trading the overall markets like I do in the E-mini think tank, you can even say, okay, well, where we are in the rotation says that we should be looking for gains in both healthcare and or utilities right now. That's where that market is likely to go, right? Because we're right here. The better performers will typically be these stocks. Well, since I know healthcare might be good or utilities, I can go out to healthcare. There it is in the center. And I can look for stocks that are, getting ready to go up. And I can look for them as a trade opportunity. You take a look at AbbVie for a second here, ABBV, and as an individual stock, on the daily chart, you see how beat up it has been recently. But if we're expecting the markets to bounce, you'd look back for an area of demand and possibly buy the demand zones when those beaten up stocks turn around, because that's the rotation. Or if we want to, we can go to utilities. Okay, remember, utilities are the next one to rally. So I go to my heat map, but I look at utilities, and right here we've got Con Ed, Southern Company, NEAT, Next Extra, Duke Energy. We can start looking at those for buying opportunities because they're the ones that are likely to rally soon. There's XEL. And actually, I was looking at this. I talked about this in the Wendell effect, and I had a buy opportunity set up on this a while back as well. But you can see on the daily chart, we're getting some buying pressure. It's not really the best of demand zones. I look for something stronger. But since I know the rotation should be coming into this, we are near some demand possibly and getting ready to bounce on those individual stocks. So that would be the top-down approach where I know that the broad market is likely to continue sinking. The sectors that are performing well are going to be utilities, healthcare. Now, remember, they may still go down, but they may not go down as much. I could do the alternative. If I know that the strong markets are those safe havens, I know that the weak markets are going to be technology, discretionary, communication services. I could look to short those weak markets. So that's a top-down approach, knowing that based on the sector rotation, we should be dropping very soon. We can look for the industry leaders in the industries that are going to be selling off and short those. So hopefully you enjoyed that. If you want to learn more, as I mentioned before, you can join me in the E-mini think tank. All you have to do is click the link that we put out there just a little while ago and join us. I'm going to put that back up again. I think it was, Miss Amy has that for me. There it was. Didn't get it. Oh, thank you. Yeah, it gives you greater, Steven's saying this gives you greater context to the notes I attached to my Twitter charts. What the heck? I keep typing the wrong address, I think it is. But yeah, Amy got the link there for you anyway. If you go ahead and click that link, as I mentioned, it'll take you here. And there's a special being run right now. It's only going to be happening, I think, for a week. So if you're interested in joining us, as I said, there's two possible subscription scenarios. One's month to month, and that's $349 a month right now. It's $50 off. Or you can do the quarterly subscription, which is about $150 off. And with the quarterly subscription, you get 2 weeks free to try it out first. So, oh man, sorry, it's a beautiful bluebird that just jumped on the fence by me. Anyway, if you try this out for the first 2 weeks, you get full access to everything. You get to join us for the 3 live sessions per week and access to all the recordings, and you're not committed. If you decide you don't really want it after or before the 2 weeks, just send us a message and that's it. You go on your way. If you like it, then you just continuously do the renewal of your subscription every 3 months, every quarter, and those prices are locked in once you're in. So you're not going to see any raise in price. Even if we do raise them, you're going to be locked in at that low price as long as you keep your subscription renewing automatically. So hopefully I give you a little insight into one of the other techniques we can use to analyze the broad market using that sector rotation. If anybody has any questions, I'd love to talk to you more about it. You can follow me on Twitter, as I mentioned, @TraderBdub. And I gave you that just a little while ago. Oops. Put it up there again. Oh, went to the wrong one. There it is. So you can follow me here @TraderBdub on Twitter or other places, LinkedIn as well. And I want to thank everybody for being here. If you got any questions, let me know. If not, I hope to see you very soon in the next E-mini Think Tank. Until next time, trade safe, trade well, everyone, and take care. If there's any questions, let me know. I'll stick around for a few minutes too to answer any questions.